Hello everyone, and welcome back to the Quant Lab. In our last video, we explored the psychological and algorithmic forces that create market support and resistance. But if you open a standard retail charting platform, you will see a massive flaw in how most traders apply this theory. Nowadays, traders draw support and resistance as single, razor-thin horizontal lines. For example, a line drawn at exactly $150. But institutional capital does not work this way. Algorithms execute millions of traders with minute variance, and hedge funds build positions incrementally over days or weeks. Aggregate capital is never concentrated at a single penny. Today, we upgrade our methodology. We are going to replace single lines with the spatial zone hypothesis, mathematically defining market boundaries at two-dimensional, dense trading ranges. Before we draw a zone, we must ask, how far back in time should we look? Institutional capital possesses memory, but that memory mathematically delays over time. In the quant lab, we apply the proximity principle. We prioritize structural zones from near to far. Capital trapped 30 days ago is highly reactive. Capital trapped 300 days ago is less so. Here are your quantitative look-back rules. First, the optimal window. Institutional algorithms primarily weigh nodes formed within the past 12 to 24 months. This perfectly aligns with the current macroeconomic business cycle. Second, the IPO limitation. Newly listed companies trading for less than a year lack the historical data required to form reliable macro zones. They are highly dangerous to trade using spatial structure. Finally, the 5-year delay threshold. Over a 5-year span, institutional holdings almost completely turn over. The trapped buyers who originally formed a zone 6 years ago are largely gone. The psychological memory of that price is dead, and the zone should be ignored. So, how do we actually define the upper and lower coordinates of these zones? To do this, we must separate the K line into two parts. The real body, which represents the accepted consensus of value, and the wick, which represents the temporary algorithmic liquidity sweep. Here is our three-step zone construction procedure. Step 1. Map the extremes. Locate the absolute peak wicks in a structural cluster. These are your outer boundaries, making the extreme stop hands. Step 2. Adjust for density. We do not trade the raw wicks. We move those boundaries lines inward to encompass the maximum number of actual K-line real bodies. We want to capture the dense overlap where the trading volume was most heavily concentrated. Step 3. Define the zone. The spatial difference between the dense body overlap and the extreme wick defines your complete trading zones. Let's see an illustrated example. Right here, Suppose we have these three K lines, and step one, map the extremes. So we can map the row extreme R2 right here and R1 somewhere here because the extremes are these 3 points and the lower extremes are these 3 points. And we're done for step one. Then step two, adjust for density. We should move this dotted line below to cover the entire body. So we move it from here to here. And then for R1, we move it up to cover most of this body. So we move R1 from here to here. And then step three is that we mark or we define the zoom in purple like this. Okay, now let's apply this directly to a live chart of Nvidia. Okay, with the current price hovering near 218 or 220, a traditional analyst will perform step one, drawing dashed lines at the absolute row weeks of the historical swings. It looks chaotic. So the resistance zones we have, the extremes are here, so we can make it around here. And then for the lower boundary of the resistance zones is around here. Okay, because we have the extremes here, 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 here. And we are done for step one for resistance zones, and for supportive zones, we can see that the extremes are here, here, and here, right? So here we have several extremes. So the step one is about here. And for the lower bound of the support zones, we have the extremes like here, 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 here. Here we have several extremes here. And again, we are looking from nearest to far. So we are right here. So we should first focus on the nearest zones. Okay. For example, here are two resistance extremes. And we should also look at the nearest zones like here. All right. So this is step one. But in the Quant Lab, we execute step two and step three. We will actively adjust those lines in words to emphasize the dense overlap of the K-line real bodies. Okay, so what we do is that, for example, we move this zone to cover most of this body, so it's around here. And then we should move this up to cover all of most of these bodies. Okay, so cover these bodies. And for the supportive zones, now we need, I would like to move right here to cover most of the bodies, and here we can move up a little bit to cover all of these bodies. And now the noise transfers into highly definable boundaries. The nearest overhead resistance becomes a defined zone between roughly here, look at here, 225 and 230. The nearest structural floor becomes a defined support zone from around 203 to 214. Okay, so some of you may move it down a little bit to 212 because it covers most of the body right here. Okay, so we don't need this bodies right here. So, but we should cover this bodies down for this upper extreme. So right here is better. So it is around 212. Okay, so let's get back to the lecture notes. Again, I have screenshot these examples and copied them in the lecture notes. Notice the numbers we are using here. The raw mathematical weeks on the chart sheet is exact decimals, like for example, 202.35 or 230.06. But we intentionally ignore the decimals around and round it to, for example, 203, 212, 225, and 230. This is our rule of psychological integers. I make a remark here. We're mapping aggregate institutional psychology, so attempting to calculate a zoom down to the exact penny is counterproductive. We expand our boundaries outward to the nearest whole integer to safely capture natural algorithmic slippage. And again, another note is that different people, different traders may have different opinions, which is fine. And this is one way to define the zoom. We will look at other ways to define the support and resistance zoom as well in later subsections. All right. So now look back at the Nvidia chart. The upper resistance zone is relatively thin. Just this area and a little bit here. But the bottom support zone is thin and blocky. Not all zones are created equal. Once a zone is defined, we must evaluate its structural density. To determine this, we use Richard Wyckoff's fundamental law of cause and effect. Time spent at a specific price mathematically equates to volume transacted at the price. The longer a stock consolidates inside a zone, the denser the institutional cost basis becomes. We classify this into 4 contiguous tiers. A weak zone lasts less than 2 weeks. It is a brief pause, easily broken, just like the 225 resistance on our Nvidia chart. And you can see there are only 3 days, which is less than 2 weeks. A medium zone lasts 2 to 4 weeks. Significant capital has exchanged hands, making it reliable for swing traders. This is the 203 support floor we just mapped on Nvidia. And if you want, you can count that it has about 2 weeks, okay, more than 2 weeks trading days inside this zone. A strong zone lasts 1 to 3 months. This is a massive concrete floor that algorithms will aggressively define. And a very strong zone spans 3 months or more. This represents the absolute macroeconomic baseline of an asset's valuation cycle. Stop trading invisible lines and start trading institutional zones. In our next section, we will mathematically define exact what constitutes a valid swing high and swing low. See you in the quant lab.